Hello, Boris Sapozhnikov is here, and welcome to the webinar about B lenders, C lenders, and alternative lenders. Let's start with disclaimer. Information is made available to you as a self-help tool for your independent use and are not intended to provide investment advice. I cannot and don't guarantee the applicability or accuracy regarding your individual circumstances. I encourage you to seek personalized advice. So, who don't know, I'm a mortgage professional that working across all of Canada, and I have experience working with different type of lenders. And I decided to create this webinar because I found that more and more people can't fit requirements of regular lenders or A lenders. So let's start. So again, welcome to the webinar, and my main goal, not only on this webinar, like in general, is to provide you educated decision. So make sure that you know what are you doing when you're applying for a mortgage, when you get mortgage, when you choose rate, whatever reason you have when you need to do anything about your mortgage. I'm doing this by following the three main rules. I will find a way, so I'm always and constantly looking for a way to make sure that you will be approved. I advise clients instruct. What do I mean by this? I am always providing professional advice, but you as a client eventually will decide in what way we will go. And the client's best interests are my priority. What do I mean by this? So I will do everything what I can to find the way so client will be satisfied with the mortgage that he gets. Okay, please use a chat. I already sent messages there on chat, so please use chat. You can ask any questions that you may have. You can introduce yourself. You can say just hi over your chat. Okay, so please use chat. I will make sure to answer on all your questions. So when we are applying for a mortgage, three main factors exist. So credit, cash, and income. When we speak about credit, it's credit score, it's credit history. When we speak about cash, it may be cash that you have on hand, or it's maybe equity in your home. And when we speak about income, is different sources of income that we may have. And most traditional lenders not accept all sources of income, and most of the traditional lenders not accept all types of credit, as same as when we speak about cash resources. There are many other factors that determine if you will be approved for a mortgage, but these are three main factors. And the good news that only two factors we need to be good to apply for a mortgage. For example, if you have a good credit score and you have enough cash, but your income sources hard to explain, we can use alternative lender to make you approved. Just as an example, if you contractor and you have your own business, it's very hard to be approved because when you collect all the documents and all the papers and you go to your local branch in any bank or credit union and you start to discuss your income, it's very hard to prove why you will be able to afford this on another amount of mortgage. If you have a bad credit, but you have cash and income, it's also a problem with the original or standard lender. Why? Because they have a federal requirement for the minimum credit score. And today's minimum credit score in Canada, 600. So if you have 599, you cannot go and even discuss anything with a regular lender. So you need to use an alternative lender, and there are many alternative lenders that will be happy to help in these circumstances. So when you have a problem with credit, but your cash and income is good, no problem, you can get. Another option, maybe you have a good credit and you have very good income, but you don't have enough cash resources. Usually in these circumstances, we need to use different financial maneuvers to get a cash for you. I'm not going to discuss in today's webinar how to do this, but you definitely can call, email, find me through the Facebook, Instagram, YouTube. You can definitely find me and I will teach you different financial tricks how you can get a cash. Again, in case if you have a good credit and you have a good income and only saving or to get cash for down payment, this is a problem. And another option, like you have a good credit and you have a good cash, but you don't have a job. A reason can be any, like for example, COVID, yeah, you just business closed and you don't have any sources of income, so it also can be solved through A, B or C lenders. So if any two of these main factors you have, it's not a problem at all to add a third factor and apply with the alternative lender. Even more than this, sometimes we can even apply for mortgage and be approved just based on one factor when two others exist but very weak. As for example, you don't have credit. Why? Because some problem past 2 years, 3 years, credit bureau, something happened and your credit score very low. You don't really have cash on your hands and you have just good income. So what I'm doing in this scenario, I'm helping people repair credit and get cash resources by using again certain financial maneuvers that help grow cash and use them for purchase property or refinance property or whatever is required. All this you can do with me. And again, as I mentioned at the beginning, I'm going to just provide you with advice and you will make decision and you will decide in what direction you want to go. Just for a second, I want to check our chat. Okay, I see one hi here. So thank you for this hi. If anyone wants to write any question, don't hesitate, write your question here. It can be any type of question, general question. If you feel uncomfortable and it's more like kind of personal question, you can wait until the end of the webinar and message me or email. So let's start with B lenders. Okay, so who are B lenders? B lenders are not directly regulated federally. And what is interesting, most of B lenders, they're not calling themselves anymore B lenders. They're calling themselves A and B lenders. So some places like credit unions, some places like monoline lenders like, for example, Home Trust, XMC, Haventree, and others, they were like B lenders, but today they also providing regular A options. So why it's good to work with this type of B lenders? Because basically you are struggling right now to get standard mortgage with a standard bank. So you applying for alternative mortgage, you can get alternative mortgage, and as your goal, you can consider with the same lender switch to a lender option. So it will be automatically, of course, better rates and better conditions. And also another myth, people thinking that B lenders it's expensive. Today I will show you several examples of B lenders and also C lenders, and you will see that their rates is not really high. As for example, here I put down that interest rates with B lenders today starting around 3%. So basically their rates very close to the A lenders rates. If A lenders, for example, you can sometimes get a little bit better rate. So B lenders usually rate just start with some number, and depends by your application, this rate can go up, and we will speak about the rates in several minutes. So what B lenders allow you to do? First of all, you can have high debt loads. So you can, for example, if you borrowed and purchased some expensive car or boat, and you borrowed too much, and if you go to the bank and you ask for a mortgage, they will say no, because you borrowed too many things and you will not be approved for a mortgage. But with B lender, if your income is stable, if you have a normal score and just a problem with the debt loads, B lenders, they are okay with this. B lenders even allow you income sources that A lenders will never allow you. For example, like contributory income. What is a contributory income? For example, family buying a house. Okay? For example, mother, father, and son buying the house. So basically, mother and father can be the main people who will be on mortgage, and son will provide contributory income. Kind of like he works somewhere and he's making money, and part of this money he gives as a support to parents to pay for the mortgage. Is with a normal lender, or like let's not use the word normal, with a lender, all lenders they're normal, but with a lender, contributory source of income is not allowed. Border income. If you go, for example, to standard lender and you say that you have a basement and you have family in the basement and you don't have anything in the basement, like you don't really have any kitchen in the basement, any separate entrance, anything, like nothing. Just you have families that live temporarily in your basement. Maybe this temporary is like for 2 or 3 years. You can use their income to help to support to pay out your mortgage. You will never get this with the A lenders, but it's allowed with the B lenders. A lot of problems around self-employed. Like if you're self-employed and your gross income $100,000, but your actually income is around $20,000, you will find a very difficult way. It will be extremely hard to be approved for any average mortgage today. But with B lender, it's possible. Of course, B lenders work with clients who have credit problems. You can have pretty similar terms with B lenders to the A lenders. You have term for 1 year, 2 years, 3 years, 4 years, 5 years. Of course, A lenders can go with for 7 or 10 years, but who today's go for 7, 10 years? It's really rarely that people taking out mortgages for 7-10 years, but with a B lender and A lender, as you can see, it's very similar. About the credit score, as I said just several minutes ago, credit score standard is at least 600, and it's hard to approve with this 600. It's possible if like all your file is very strong and just a problem with the score and it's just 600, and you don't have any consumer purpose, it's just small score because misuse of credit card, something small, okay? So only if in these circumstances you will be approved for standard A mortgage. But if your credit score 560, 550, you basically will never be approved with the A lender. And in a lot of circumstances, it's hard to be approved with the A lender if you have score in between 600 and 660. So with B lender, no problem at all from 550. And in some circumstances, if you have confirmed very good income, no score required. So if your score like even worse than 550, let's say around 400 something, but you have a good confirmable income, B lender can close the eyes and forget about the score. 35 years amortization. You will never find with the A lenders 35 years amortization. Okay, so why it's good to have 35 years amortization? If you want to make your payments smaller, you make longer amortization. If you have extra money, you can always add to your payments, but it's very convenient to have 35 years amortization. So if interest rate is not 3, like let's say around 4%, and you feel kind of uncomfortable or difficult to make payments, you can stretch amortization. So you're basically, you will not feel this higher interest than compared to others, because your payments will be smaller because of long amortization. As many of you know, standard amortization in today's in Canada market is 25 years. Some lenders allow up to 30 years. So again, B lenders go up to 35. One negative point that we need to remember, B lenders required fee. So it's not a free mortgage. What do I mean by free mortgage? Like if you apply with a standard lender, like a bank, online bank, through the broker, directly, if you get a mortgage through them, you don't need to pay any fee to get a mortgage. Here's additional fee. So every B or C lender or any alternative lender, you should pay a fee. A fee starts at 1%. In most of the cases, we can stick with this fee of 1%. Now, 1% is not from the purchase price. 1% is just for mortgage. So it's always smaller, and some people not pay attention to this. So fee is 1%, but it's from size of the mortgage, not from the all size of home or residence or whatever. So please pay attention on this, and I want to check a chat. Okay. So one of the questions, do you work in any province? Do lenders have to be in the same province as the client? Okay. So thank you very much for this question. Yes, I work in any province in Canada. I believe at the beginning of presentation, I say that I am a mortgage professional who works across all of Canada. So if you're in Yukon, or if you're in British Columbia or Manitoba, my physical address is Winnipeg, Manitoba, office in Winnipeg, Manitoba, but I allowed to work and can go and do mortgage across all of Canada. lender is something different. Some lenders, they work with several provinces. Some lenders work across all of Canada. Some lenders works only in certain areas of, for example, Ontario, okay? Some lenders works in certain areas of Ontario, but in other areas of Ontario, they are not working. So when I have a client, it's very important for me to know where is the property located or where is the future property will be located. Based on this information, I am choosing only lenders who work in this area. So sometimes it's a lender who works across all of Canada, sometimes it's just a local lender. What are the current rates? As I just mentioned, we are speaking about alternative lenders. So current interest rate, as you can see on this slide, like you can see the rate starting with 3%. Okay, what will be your personal interest rate? I don't know. And honestly, no lender and no broker can know your interest rate. The reason that how alternative lenders work, they look on all your application and every point matter. What do I mean every point matter? If you have a credit score 495, it's one credit rate. If you have a credit score 505, it's another credit score. And about about interest rates, I will speak further. And can you buy a lot with them? Yes. It's so another question was, can you buy a lot with them? Unlimited. So basically, you can purchase, and purchase will be unlimited purchase price. Like, yeah, like some lenders, like A lenders, they're limited by certain rules, certain prices. Alternative lenders, you can purchase multi-million. You can have several properties. So they're much more flexible than any other lenders. Okay, so I will continue my presentation. Again, if you have a question, please return to the chat and ask your question. Now I want to explain what LTV or loan to value. So I'm going to speak in a minute about different things related how you can go approved for certain rates. So I want that you will understand what is LTV. LTV is a ratio, is calculated by dividing amount borrowed by appraised value of the property. Okay, so for example, you borrow $400,000 and property appraised for $500,000. So 400 divided by 500, we will get 80%. So LTV will be 80%. So with B lenders, they have very strict policy across all of B lenders, but in several minutes we will speak about another lenders as well. But B lenders, they require that you will have LTV 80%. So you need to have or down payment 20% or equity of 20%. Okay, this is requirement for B lender. So if you want to get into B lending, not C. C can be different. In B lending, you must to have 20%. And it can be partially be borrowed. So this is, you can call me and I will explain how you can borrow it. Problem with the standard lenders is a stress test. Like for example, GDS TDS no more than 3944. I want to explain what is a GDS TDS mean, because a lot of people go into the bank and bank may say, oh, your GDS too high, your TDS too high. So they don't understand where is the issue and how to deal with this. So I will give this information so you will know how to approach it. So if you have your income and you apply for a mortgage, so what bank doing is taking your monthly income or annual income, it doesn't matter, and it divide on all your monthly housing costs. So it's a mortgage, it's a heating, and it's a property taxes. And when they're doing this division and they will get 39% or lower, you're good, you can go to the A lender. If you get this higher, you're in trouble and you cannot apply for A lender. TDS, very similar to GDS. So you're dividing your monthly or annual income on all your debts. So it's mortgage and heating and cars and property tax and any loans that you took, and it must be under 44. So if you go to the traditional lender or A lender, you must have 44. So what is B lender doing? B lender can go up to 60-60 or waive it. So they may look on your file and say, oh, this person wants to purchase some expensive property and he's struggling because he doesn't have enough income, but he has cash. He said for down payment, he has cash. He has 20%. So he has 20%, income is not enough. But he has a good score, or he improved his score recently. So remember, at the beginning of presentation, we need 3 factors: credit, cash, income. So income exists, but it's not enough. A problem that you cannot pass a stress test, and especially in areas like British Columbia, Ontario, Quebec, when we are going to purchase a big property, or even here in Manitoba, if you want to buy something that costs million something, your income probably will not be enough, and you probably will not be able to pass the stress test. So in these circumstances, if you have stable income and you know that you can manage this and you can explain this, like what is good with B lenders, they are looking on a person, they're not looking on the papers. If you can explain to your lender why you can manage this, because you can prove and show like you pay very high rent, and you can say like, I'm paying rent for my 2-bedroom apartment in Toronto, $2,000, so I definitely can afford to buy something and pay mortgage that will be $1,500 or $1,600. But sometimes you cannot pass stress test. But what is doing B lender? He allowed 60-60 and he can waive this. So if you saved for down payment and you have good credit score, it doesn't have to be extremely good, just around normal, around 600 score, you can pass. You can pass, you don't need to go through the stress test. And you can get an interest rate around 3%. So it's very similar to what people getting going to the A lender. A difference will be just several dollars. Okay, before I'm starting to speak about rates, I want to look on. Okay, I mean a land. Yes, you. Okay, Leo, you asked about if you can buy a land. Yes, you can buy with alternative lenders land. Can you buy a piece of land with a B lender? Usually yes and no. Not every B lender like helping you with buying a land purchase without any properties, like just bare land, it's different story. But I have alternative lenders who may help you to buy a bare land. But you have to know that in most cases you should have at least half. Okay, so for example, if land costs $200,000, you should have half, like $100,000. Okay, you can try to borrow this some way or part of this. It's totally different story, but again, alternative lenders help to buy better land. One more question. Can you get a construction mortgage if you already have land, the land is paid off? Yes, it's not a problem. Yeah, you can get any type of mortgage with B or alternative lenders. Any type. Okay, I'm going back to my presentation. And okay, rates. So how rates, like as I said, we are starting with 3%, 3.1, 3.2, 3.3, it's going up, where it stops. So if you shop early and you have enough time, so you give me time as your mortgage professional to find you a better rate, so it's better for your rate. Like if I can try one lender, I can try another lender, so if I have more time, we will start shop early, so you have time to pick better rate. Credit score and credit history. It's obvious. Better score, better history, you have better rates. If you have consumer purpose on your credit history and even good rate, it will not help. A lender may decline, B lender will never decline or almost never decline, and you can get a mortgage. Employment type and income. If you self-employed, it's one type of rate. If you have a business and business purchasing property, it's totally different rate. So employment type and income is matter. If you are working professional, like for example, doctor or you plumber, okay? It doesn't matter what profession you have. B lenders have special rates for professionals. So it's very important in your application, be clear who or what is your source of income. Okay? Because sometimes you even don't realize that you can get promotion and good rate just because you're plumber or because you're electrician. Okay? So a lot of specialized rate by profession. Loan size. So if your loan size relatively big or small, rate will change. A lot of lenders will not even provide any mortgage if loan size will be too small. So usually we need at least 100,000 in mortgage to get some kind of rate. And of course, if your mortgage more than million, it will be totally different rates. Home value appraisal. It's very important how your house will be appraised. So if it will be have one value or another value, it can have influence on rates. The more value in home and less mortgage, so basically what I just spoke about LTV, the less LTV usually it's mean better rates. And usually all LTV rates divided by group of, if your LTV is around 95, 90, until 80%, you can get a good rates because it's insurable, but it's impossible to get through alternative lenders. When it starts 80%, it's usually highest rate. If 75% LTV is better rate, 70% even better, 60, 65. So the less you borrow compared to the home value, the better rate you can get. Length of term. the less length, if your length of term is just 1 year, you can get much better rate than if you take length of term for 2, 3, or 5 years. Why it's so? Because this type of mortgages, they're very risky mortgages for the lender. Because if you are not approved by A lenders, so something wrong on your application. So what they want that in short period of time, in 1 year, hopefully, if not in 2 years, you will fix the problems that you had before, or increase your income, or improve your score, a credit history, or paying down mortgage, you decrease LTV, so basically you borrowed less and your debt load is going down. So they want that as fast as possible that you will switch to A. So this is why a lot of B lenders have also A department. So you can easily switch from B to A. We spoke already about amortization. The longer amortization, the usually rate going up. It depends if your home is owner occupied, if it's second home, or it's rental home. So it's going like if you're owner occupied, you have low rate. If it's second home, higher rate. If it's rental, even more higher rate. It depends by province. Some discounts going only for Ontario, British Columbia, unfortunately, or fortunately if you're in their provinces. And you can get just discount just because you're in Ontario area or British Columbia. And also it's important to know if loan type is open or closed. So if it's open, rate will be higher. And also it depends by availability your mortgage professional. You may hear about it, maybe you know, maybe not, but a lot of mortgage professionals have access and able to buy down the interest rate. So actually if rate, for example, 3.3, they may be able to make it 3.25, just for an example, or 3.2. How they're doing this? They are using their own future income toward interest rate. So they say, for example, I am doing this constantly with all my clients. My client, we are applying for mortgage, getting all papers. Here's the papers, here's the rate. And when I negotiate with the lender, I'm always say, okay, can you compensate me less and get a better rate? And it's all like ultimately in most scenarios, if they agree. In some scenarios, no. I can say in 99% scenarios, when you have term just for 1 year, they say yes. It's no problem. When it's 2 years, it's more risky for them. They may say no. Okay, I want to check if maybe other questions appear here. Do you need down payment? Of course you need down payment. Yeah, when you purchase a home, you need down payment. So if you thinking to purchase a home without down payment, it's kind of tricky situation, but it's possible to do. Unfortunately, B lender will not help you, not C lender as well. If you don't have any cash, okay? Don't have. But you have a good job, you have very good job, good income, you have good credit score, and you have just one problem with the down payment can be created. Down payment should be for construction mortgage, yes. Like you should have some kind of, if you have 20% for down payment, you can go with B lender, private lender. But if you don't have this 20%, you should create this down payment. There's many ways how to create down payment and different lenders for this. Okay, so if you don't have down payment, it's not for B or private lending. Okay, I want to give some live life examples. Okay, it's good to speak about some kind of lenders. It's good to tell stories. Everybody know how to tell stories. Many mortgage professionals know how to tell amazing stories about different options, about different lenders. But you can read this online. You agree with me? So let's look on live example the mortgages that were funded with B lenders. Okay, so I will not use names when I'm providing examples, and I will not let you know in where they are located, but I will give you very good idea what happened to this specific family. So in this example, family, it's a couple. It's a kind of people who not really have any good sources of income. One of them is business for self, so self-employed, and income was not good. And his partner is retired and have just pension income. That's it. And a lot of lenders not even looking on pension income. A lot may look, some look differently. This is all what they had. They had a good credit score, and when they applied for a mortgage, this is what happened to the rates. GDS was 46.87 and TDS 48.29. And if you remember, standard test says 39.44, so they not passed with any banks. So they had 22% down payment, 22, and because they have a good score, we were able to approve them for 30 years amortization with the interest rate 2.94. This rate today you can get with traditional A lender, and they got this through the B lender. This is exactly what I said at the beginning. A lot of people believe in the myth the B lenders are expensive. No, they are not. 2.94 is easily proof this. Okay, so they got their mortgage and they have plan. So in a year, improve their GDS, TDS, pay down some debts, and hopefully go to the A lender. If it will not happen, they will just renew with the same B lender. Another example. A healthcare professional had very bad credit history. And in not just bad history, prior consumer proposal. So already one problem, we have a bad credit history, bad credit score, like credit score 617. If you remember, I said a lot of banks, like Canada standard today is 600 at least. This person had 617. He believed that he can pass in regular bank. He was not able to pass because score is not everything. He has very bad credit history. Not only is this a problem, GDS, TDS, not instead 39, 40, more than 40, and instead of 44, 51. So because of so many problems, his rate was much more higher. And bank allowed him refinance his home on 30 years amortization. So for 2 years, because he needs a lot of time to repair what happened through consumer proposal. And it was approved on LTV 68%. And this is another living example. And the last example that I want to provide with a B lender is about young realtor that just started to work. Okay, a new young professional just finished high school and started to work, and only 5 months in the business. So if this traditional lender, he needs at least 2 years to be approved for a mortgage, because they want to see his income for 2 years, because every realtor or real estate agent, they should have commission income, and they should show that this income is stable. And you cannot explain, you can't say, oh, 5 months were good and another year or 2 will be good too. So traditional lender declined. Not only this problem, look on GDS TDS, it was 53 instead of 39, and instead of 49, 54. He had very good credit score. So what we did, we helped him with the purchase. He had 25% down payment. We stretched his amortization for 35 years, and we put him for 1 year. So in 1 year, he will see, he will stay with the B lender, or maybe will do something different. For example, if he will be able in a year put GDS TDS lower, so he will have already 1 year and 5 months of experience. It will be relatively closer to 2 years. He will have some kind of slight chance be approved with the A lender. Probably not, but he will definitely get a better rate in a renewal time. And rate not bad at all, 3.25 is very close to today's standard A rate. Okay, before I start with the C lenders, I want to look on the example. Okay, I saw examples, looks okay. I want to look on questions. I don't see any additional questions, so I can move forward. Okay, C lenders. C lenders, private lenders, is usually mortgages for short term, in mostly interest only loans. And all idea of these loans, to get this loan for short period of time and solve a problem that you may have and move from C lender to B lender. I'm always, when I'm working with a person, I'm trying to move him from C to B, from B to A. So C lenders allowed higher debt loads, allow different income sources, work with clients with a very bad credit problems. You can get with C lenders 3 months term, 2 years term. You can do a custom term. So you can say, I want mortgage just for 4 months and a half, 35 years amortization, and interest rate starting around 4%. So if B lender started 3, C lender started 4, so it's higher. Also, a fee that you pay to C lender starts at 1.5%, so it's more expensive. What will be your rate? What will be your fee? We will know only after you will submit your application. And I always say, you're not losing anything. Like, what are you losing? Not doing anything. This is what when people are, if somebody sitting at home and dreaming that maybe he will improve here, improve there, improve here, improve there, so he will eventually be approved by Banco Credit Union, but you can wait another year, 2, 3, 4, 5, 7, until you will eventually improve. If you take action, if you start to do something, you eventually will be there where you want to be. And one of the things that helps to get action is to start application, try to be approved, get propose, look on this propose. If you like it, if you think that you can manage it, do it. Not, it's no obligation. Nobody will not say, oh, you started application, why are you not finishing? No, nobody never says this. So it's better to try than not to try at all. So this is a C lenders, and how you qualified with the C lenders. I put here LTV up to 90%. So with private lenders, sometimes You can go up to 90%. I'm strongly non-recommend to do this because basically like this 10% you will borrow by very high interest rate. What I propose to do some financial maneuver. I can teach you how to do this and borrow this through different or other programs where you can actually borrow and add some money for your down payment. But if you want to go with private lender up to 90, you can. My main recommendation, not to go more than 80. You can get first mortgage, you can get second mortgage, you can get third mortgage with the private lenders. What does it mean? You can have one mortgage and put on top another mortgage and put on top another mortgage. So it can be kind of very complicated mortgage on mortgage on mortgage on mortgage. So it helps to borrow more and go up to 90%. So payments from 3 to 12 months available. So no minimum credit score. It's no score required at all. If you laid off, you can qualify. If you have a collateral charge mortgage, you can qualify and add to on top of collateral charge mortgage, private mortgage. If you have cheap reverse mortgage, you retired, you can get in addition to cheap mortgage, private mortgage. So completely, it's extremely flexible and everything possible. Okay, I have several live examples here. Before I start live examples, I just want to look on the questions. I don't have any questions. If you're still with me, please ask questions. And live example first. So, client was seeking financing, purchase newly constructed owner-occupied home. He was pre-approved. Everything was good with TD Bank. But something happened and he didn't get approved. Okay? I don't want to go in details why TD declined his application, but he was declined. And what happened when you finish in construction and you decline? You can lose everything, lose money that you already put as a down payment. You can lose your construction, you can lose everything. So what he did, he used private mortgage. We were able to approve him for 5.99%, relatively high interest rate, but for very short period of time until he will switch it to the B lender. As I said, when we have a C lender, our goal to switch to the B lender. So problems that he had is fixable problem. So he tried to fix them in order to move to B lender. Another example. A self-employed construction worker broke his foot and was not able to work for entire year. So as a result, his debts went to collection. His property taxes were in arrears. And he required funds to repair his roof. Like a lot of problems with this specific construction worker. So because of all this complex of problem, it was clear for the lender that this person is not able to get any income soon. This is why his interest relatively high, but in 1 year he will be able to return. So he started to get some money through compensation board, through other resources, and all this money will help him slowly to repay this mortgage. 8.29, it's not too high as it looks like, because he will pay just interest. He will not actually pay mortgage. Okay, so his mortgage will stay on LTV 59%. It will not change. He will pay just interest for 1 year. And after this, he will be able to fix everything. The mortgage that he got enough to cover all his debts in collection, cover all his property tax problems, cover enough for repair roof, everything. So this was a complete solution for him. And the last one is example about the divorce. It's very tragic story. So what happened here, wife and husband, they had 4 kids. They have 4 kids, so they separated, okay? And husband promised to pay a mortgage, okay? So it was a court order, everything. He was supposed to pay for the mortgage on the house where his wife and 4 kids live. And he never did this, okay? So imagine one day she come back home and what she's found? Foreclosure notice on the door with a date for the locks to be changed. So basically, your house will be sold and she will be on the street with 4 kids. So how this problem was solved? Private lenders, they can act very fast. Sometimes anything can be completed in 24 hours. As soon as we got a call, private mortgage was arranged on 6.99%, LTV of the home 33%. Private lender pay out all costs of mortgage that was not paid in time. Now, all this sent to the court. Court will require from the husband return all this money, and we will refinance again, and we will move her to the B lender and from B lender to the A lender. So she will be fine, okay? But if she was not just taking this notice and leaving her home, and it's happened to many families, divorces through like this COVID happened a lot, and people sometimes don't know what to do. If you have a home and you go through the divorce, you should go to the mortgage professional first, even before you go to the lawyer or notarian or whoever you go, because you need to make sure that something will be done with the mortgage. If you don't, okay, I want to go and look on the questions. Do they report this mortgage to credit bureau? Of course. And this is a good idea that mortgages will be reported to credit bureau. And by the way, I want to speak about this mortgage reported, not reported to credit bureau. Actually, it was a long history of a lot of credit unions that credit unions were not reporting to the credit bureau mortgages. And people were happy, oh, my mortgage not reported to credit bureau, so I'm going clean without mortgage. And a lot of credit unions were doing this for a while. I probably will surprise you, but today they're obligated to provide information to both credit bureaus that you have a mortgage. So it's not optional anymore. So how you will see this in your credit bureau? You will see, for example, if you have a mortgage, if before you had a mortgage through credit union, it maybe was not reported, and when you was going to the mortgage section, oh, I don't have a mortgage, but you actually have a mortgage, okay? But now, if you go on your bureau, you will see mortgage from non-reported source. So actually your mortgage reported and all your payments reported, but credit bureau is not, it doesn't know who is the source, okay? But what is the matter? Like, it doesn't matter for credit bureau if your mortgage at TD, Scotia, or credit union, it's still a mortgage, okay? So it's not really helpful or useful that mortgage reported from unknown source. Yeah, so if question is to create mortgage and make sure that mortgage will not be reported to credit bureau, it doesn't make any sense. It will not help with anything from what I see. Maybe if you have an extremely private case and you may explain me why you need that your mortgage will not be reported, we can think about the solution. But in general, it's good when mortgage is reported. Why? Because you maybe will miss a payment for your car, and maybe you'll miss payment for your credit card from one grocery store, but you will never miss payment from the mortgage because it's installed and attached, and banks always make sure that first of all to pay your mortgage. So it's rarely that your mortgage will not be paid on time. It's only if you constantly have an account like with a negative balance, so not even some kind of positive balance. I will say, if anyone have a really deep problem with the debt and never had any home and never purchased anything, it's better to fix this problem first, like go out of deep debts before applying for a mortgage. As soon as you're ready to, and you have like just several problems, it can be solved and you can get a mortgage. Okay, so this is my answer on this question. In general, everything must be reported to credit bureaus, and even if it's not reported, it will be somewhere reported and it will appear as non-known source of mortgage. I want to explain why I put this picture here. This picture in general explains my tactic when I'm working with people. So I'm not assuming that person have to go to the C lender, like all these houses that you see on the picture with the C mark is the C lenders. And when you see kind of V, like here at the bottom, you can see like this type of V, this type of V, this type of V, this kind of BA lenders here. So I just will explain you an example. So if your credit bureau very bad, under 550, you don't have a choice. You go straight to the C lender. So everything starts with your credit history and your credit score. If you have at least 550 and up to 600, usually you have two ways here. For example, you have business, so you go here, and you cannot prove anything about your income in the business, so you should go to the private lender. If you can show something on your business income, we can try to approve you with B lender. If it's something around 50 or even 60, you probably will be approved with a B lender. If it's more than 50 or 60, you will need to go to the private lender. So this kind of slide, I want that you will take several minutes and may try to put yourself on this slide and see where you're landing. So it will give you much better picture how all this ABC lending works. So again, when you come to this point, oh, sorry, I want to return. So if you come to this gold point, it's or A or B lending, or here, or here. But if you come to this point, it's C lender. Or here, all these houses with a C, it's private C lenders. So it's kind of general approach. Of course, for any approach, we can find another way. And as I said at the beginning of presentation, I will find a way that you will get a mortgage. Okay? Even if it will take some time, I will find a way. If your problem is a credit, we will go and we will fix it. Okay? If you can fix it completely, we will fix it completely. If you can fix it kind of temporary, so it will be approved with the B lender, we will do this. Some people say me, like, why to go with a bad credit and pay high interest rate and purchase something with a B or C lender? A reason why, it's because if you're waiting that your things will become better, you can wait kind of forever. Sometimes it's a good idea to purchase something that you can afford now and wait after. Because when you purchase something that you can afford now with the B or C lender, it increases price with inflation, and everyone knows that we have inflation right now. So it will increase price anyway with inflation. It will increase price just because prices increase. Just in last month, in January, okay, previous month in January, across all of Canada, every home, condo, doesn't matter what kind of property, okay, residential property I'm speaking, it doesn't matter where you live, in 1 month, January, across all of Canada, it was increased in 3% in every property in 1 month. It's like huge amount of money. Okay, and ways that it will increase again and again and again, we can wait forever. So reason is do as fast as possible, because go down the slope, find the way A, B, C, and complete it now, because down the road it will be more expensive and more challenge. More expensive and more challenge. Okay, I want to go to the next slide about questions and answers and look if any questions here. Okay, I don't see any questions. Great. So I will just wait maybe another minute. And if it's no questions here, we can finish this webinar, and I hope you enjoyed.